Happy morning, people. So, yes, new day. So, new topic. The topic that we are going to take up now is Ind AS 105. Ind AS 105 talks about non current assets held for sale and discontinued operations. Two aspects we need to know from this particular topic. One is when does a non current asset become held for sale, and what is discontinued operations? If at all it is non-current assets held for sale, what to do? If at all it is discontinued operation, what to do, or what impact it shall have in financial statement is the scope. Easy standard, hardly like four, you could say like 5 to 6 concepts and some 5 to 6 questions, and more or less we are done. Okay, chin to pin to topic only. Okay. But from tomorrow onwards, we will be starting financial instruments. That will take all the official big chapters will start from tomorrow. Okay, sir. Before that, one small chintu topic. Let's get this over with today. Okay. All right. And this Ind AS 105 ka reference, we have seen it in few standards, right? We have seen if a PP is held for sale, if a property, plant and equipment is held for sale, we don't apply Ind AS 60. It comes under Ind AS 105 provision. Now we're going to learn more about when does any non-current asset become held for sale. That's the first aspect that we're going to learn. Okay. Sir, held for sale means it is not yet sold, but we have an intention to sell. Okay. Held for sale meaning not yet sold, but we have an intention to sell. That's the plain basic meaning. Okay. Now, if you want to call it as non-current assets held for sale, it's a simple common sense meaning. If you want to call a non-current assets as held for sale, one, the intention should be to recover the money from that non-current assets by selling and not by using. Normally, people, when you have laptops, iPad, furniture, machinery and all, no, if we have it means we would have bought it, right? If we have purchased an iPad, like an ArivuPro, if we have purchased an iPad, our main intention is what? To recover whatever amount we have invested through in this iPad by using the iPad. We want to utilize this iPad as much as possible to conduct class and recover the money. Yes or no? Correct? But if your intention changes, instead of using, if your intention is to recover the money by selling, now if your intention is not to recover the money from this iPad by using, but by selling, then it gets called as non-current assets held for sale. Okay. Now we no more have the intention to use it and recover it from it. Now our intention is to sell it off and recover the money. That's what this particular definition is trying to say. Okay. Simple common sense language. Okay. All right. Now people, why do we need to know this is, if you classify any non-current assets as held for sale, if you classify, there are some conditions for it, which we're going to talk about it. But by chance, if any non-current assets gets classified as held for sale, it should be shown in your financial statements separately. Ind AS 105, such non-current assets held for sale, like if you have any building which is held for sale, or if you have any machinery held for sale, you can't show it under PP. You can't show it under PP. It has to be shown as a separate category in balance sheet. In balance sheet itself, we have to show it separately as non-current assets held for sale. The reason is, when you show it separately, like people, when you have, if like let's say machinery, company has an intention to, a machinery which is used for production. In the current year, if company decides to sell it, that's a major decision, isn't it? Correct? If a machinery which is used for production, company has decided to sell it means, right, there might be something going wrong with the company also, right? Because you don't want to sell an asset which is used in the production. If this asset is getting replaced, then no problem, things are going smooth. But if company is planning to sell an asset and does not have any intention to replace it, that might send a signal that something is wrong with the company. Hence, Ind AS 105 says you show these assets separately so that it will help the users to interpret and make their decisions appropriately. Okay, this is more for decision making purpose. So don't show it as PP or intangible assets. Show it as a separate category in your financial statement. Usually we show it under current assets. Okay, fine. But standard says you need to show it separately in balance sheet. You can make a separate category and also unshow. But usually if you check annual report, they show such assets under current assets. This is the point, 2 points. Are we comfortable, people? Once again, if you want to call an non-current assets as held for sale, our primary intention is to recover the money, not by using, but by selling. That is point number 1. And if an asset gets classified as non-current assets held for sale, okay, there's some conditions. If those conditions gets fulfilled, it gets classified as held for sale. If it is held for sale, you need to show it separately in your financial statement. You can't club it as and show it under PP or intangible asset, but show it separately. Those are the first 1 minute, people. There's some sort of noise. 1 second. Okay, sorry, there was some noise, so I wanted to look into that. Okay, so this portion is clear. Can we get to the next portion, people? Okay. Next one is disposal group. Disposal group. What does this disposal group means? Sometimes what happens, we don't have an intention to sell one assets. We may sell group of assets and liabilities together. Instead of selling machinery alone, we may decide to sell machinery, furniture, building, and some associated liabilities with it. That we call it as disposal group. Simply a group of assets and liability which we are planning to sell off as a single transaction. All this will come in the problem, so we just need to know the meaning of it. Okay, sir. Done. Now the next question will arise, sir, when does a Ind AS 105 cup provision get triggered? When can you call non-current assets as held for sale? When does non-current assets become held for sale? People, if you want to classify a non-current asset as held for sale, there are 7 conditions to be satisfied. Actually two, but for the second criteria to be satisfied, there are 5 more to be satisfied. So that way, if you remember, there are about 7 conditions to be satisfied for a non-current assets to get classified as held for sale. Okay. Now let's go over these conditions one by one. That we will remember for our class purposes. CPMBASW. CPMBASW. What is this C? It should be sellable in present condition. First, once I'll call it out for you, then we will spend a minute understanding each component. Okay, fine. All right. Usually they will pick these provisions and make a small case study question. You need to tell whether the conditions are satisfied and can a non-current assets get classified as held for sale. So most probably you'll not be expected to mug up this and remember, okay, because they will test you and through a case study. So as long as you're able to find the right answer, it should be okay. But I would suggest still better to remember these things. Okay, C for it should be sellable. That non-current asset, non-current here assets refers to here your PPs, intangible assets, etc., etc. Right? Now that PPs or your intangible asset that we are calling it as non-current assets should be held for, meaning it should be sellable in present condition. Meaning the way it is right now, you should be able to sell it as it is. That is your C. Okay. P for the sale must be highly probable. The sale to be highly probable, and in order to prove that sale is highly probable, these 5 criteria should be satisfied. M for the management should be committed to sell. B for active program to find the buyer is already launched. A for asset should be actively marketed at a reasonable price. S, the sale to be completed within 12 months from the day it is classified as held for sale. W, plan not to be withdrawn. So if all of them are satisfied, if these 5 conditions are satisfied, we say sale is highly probable. Along with sale highly probable, if the sale, the non-current assets, if it is sellable in present condition, then you can apply Ind AS 105. All of them should be satisfied, people. Okay. Now let's go a little more in detail. One by one, let's try to pick it up and try to understand a little more about this. C, we are remembering it as what? CPMBASW. Okay. C for it should be sellable in present condition. Sellable in present condition means as the way the asset is, you should be able to sell it currently like that only. The way, in whichever condition asset is currently, in that condition only you should sell it off. Like, just to give you an example, let us say company has decided to sell a building. That building has 2 floors. Currently, that building has 2 floors, ground floor, first floor. Now, company has decided to sell this building, but what company also wants to do is they want to construct one more floor. Currently, 2 floors are there. Company is saying, I will construct one more floor and then sell. Currently it is 2 floor and they want to build one more floor and then sell. Now you would tell me the C wala condition, satisfied or failed? The C wala condition, sellable in present condition, satisfied or failed? Failed. Why? Sir, C means it should be sellable in the present condition. Present condition means what is the present condition of this building? 2 floors. If the management has an intention to sell this 2-floor building as it is, then we say today it is sellable in present condition. But in this example, company wants to construct one more floor and then sell. That means the day this one more floor is completed, the day this one more floor construction is completed, that day you can say condition C is satisfied. Currently, it is not sellable in present condition. That is what it is trying to say. So today you cannot classify this asset as non-current assets held for sale. After this one floor is constructed, then if other conditions are also satisfied, then you can classify it as held for sale. Better are people? Comfortable are people? Okay. Now they have given some examples for this present condition wala criteria. So let's go over them. Now look at this. A property is being used as headquarters. Company currently is using this building for their business purpose. Okay. The entity needs to be vacated before it can be sold. Okay. Now people, if you are already using a building for your business purpose, now if you decide to sell the building, you need to vacate your premises, no? Right? You might have your furnitures, right? You might have a lot of things within the building. All that you need to vacate it. And to vacate it, it may take like maybe 3 weeks, 4 weeks, or 1 month or 1.5 months delay. That is possible. So if there is a customary delay, customary delay means to do the transaction, there will be some delay. Like sometimes when you want to sell a building, registration may take like 1 week, or there could be possible like that, right? Those sort of customary delays are acceptable. That's what they're trying to say over here. If a property is being used for headquarter purpose, and if that property, now before you want to sell it, you want to vacate the building. Now vacation will take some time. Let's say vacation takes 1 month time. To vacate that building, it will take 1 month time. Now the question will arise, will you classify this building as held for sale today or after vacation, that is after 1 month? So this vacating the building is a customary delay. It is a normal for this transaction, yes or no? So that means you will not classify it as held for sale after 1 month. You will classify it as held for sale today itself. Meaning you would say it is sellable in the present condition today itself and classify it as held for sale provided other conditions are also satisfied. Understood, sir? Now taking the same example, if you build it up. Now let's say company says, currently we are using this building for business purpose. Okay. Now we will vacate. In order to vacate, we may have to find a new building also. Suppose you tell, look at this example. If a property is vacated only after replacement is available, meaning we will vacate this building only if you find the new building. Then if you say, then the property is not available for sale in the immediate condition. Okay, that's what we did. You need to analyze like what is customary delay based on transaction to transaction. Okay, and it may differ from area to area also. Correct? Maybe in some part of the world, delay may be acceptable. Okay, in some regions of the state, that delay may not be acceptable. So you have to analyze this. What is customary delay depends on circumstance and case to case wala basis. Everybody good so far? One more example they've given over here. An entity cannot classify a manufacturing facility. Like let's say if manufacturing facility refers to a factory. An entity cannot classify a factory as held for sale if prior to selling the facility, it needs to clear backlog of uncompleted order. Let's say we have taken up an order, manufacturing order. Okay. So that means those goods, we have to produce it. We can't cancel out of it. Now, company has decided to sell the factory. Is the factory available for sale in the present condition? No. Why? Because people, you still have an unfinished order. You cannot shut down the factory immediately. You still have an unfinished order which you need to produce and give it to your customer. So hence, it is not available for sale in the present condition because you still have an unfinished production to be done. Taking the same example, taking further, in the above example, if the entity intends to sell the manufacturing facility along with uncompleted order, then it can classify it as held for sale. Meaning we want to sell the factory and we are telling the buyer, boss, I have an unfinished order. I cannot complete it. You should complete it. with that intention or with that reason, if you are selling the factory, then you can say it can be classified as held for sale because it is sellable in present condition. Because we are not going to finish that order now. That particular activity we are passing on to our potential buyers. So again, you'll have to analyze based on case to case. Any doubt in this first wala condition so far, people? Sellable in present condition. Doubt or got it? Again, no need to mug up the example. They will give you this case study. All you have to do it is condition satisfied or not. That's what you need to basically identify in these cases. You need some time, people, or can I carry on, people? Quickly response would be nice. Oh, especially early morning. Oh, online mode. Oh, yeah. Some response. Oh, any problem or all okay? Okay. Move on, sir. They're telling. Okay, move on, sir. Then next point. All right. Two conditions should be satisfied. We said two basic conditions should be satisfied for Ind AS 105 to apply. What are those? CP. C for it should be sellable in present condition. That we saw. Second one. Once you want to see the conditions. Over here. Okay, I'll maybe keep the screen here. One C. First condition is C. C for it should be sellable in present condition. P for sale must be highly probable. Now let's spend a little time on sale must be highly probable. It is there, people. All this, whatever I've written, right? It's there over here. Available. See, these are the two main conditions. But in order to say that sale is highly probable, further 5 conditions should be satisfied. Now, these are all pretty common sense. Check. If you want to conclude sale is highly probable, M. Okay, first M should be satisfied. M means management is committed to sell. Meaning management should not be cranky. One day they are selling, one day they are telling we will sell the machinery. After 1 week they are telling no, we will not sell the machinery. That sort of confusion should not be there. If you want to say sale is highly probable, management should have a clear commitment to sell it. Right? Maybe they should have taken in the board meeting, a resolution should be passed saying we want to sell this machinery. Some evidence should be there to prove that management is committed to sell this. That is your M, common sense. B for, now if you want to sell it means you have to find the buyer, no? Right? So program to find the buyer is launched, meaning marketing activity should have started. Because big assets, no? Sometimes if you want to sell a factory and all, right? Factory could be worth 100 crore, 500 crore, 1000 crore, possible, no? Some assets value could be really huge, correct? So you may not have, it may not be that easy to find the buyers. So you may have to launch an active marketing campaign. That is what B is trying to say. Is the active program to find the buyer already launched? Meaning is a marketing program already started. That is your B. Okay. Then A for, now if you want to sell the product, you will sell it at a particular price, right? No, that A is trying to say is the asset actively marketed at a reasonable price. Now let's say the market value of that the fair value of that asset. Let's say company wants to sell a factory. The fair value of that product of that factory is 10 crore assumption. The fair value or market value is 10 crore. But company is marketing it at, let's say, 25 crore. Company wants to sell it at 25 crore. That is the expected selling price company is expecting. Now you tell me, what are the chances that the sale will go through? What are the chances that the sale will happen? Not much, yes or no? Because market value is only 10 means maybe you can market it at 11 or 12 crores because buyers will ask a discount. Yes, comfortable. But if you are asking like almost double, 2 to 3 times of your market value, then the chances of this asset getting sold is not highly probable. Most probably it may get unsold only. Yes, that's what A is trying to say. Asset should be actively marketed at a reasonable price. Reasonable price means it should be marketed at reasonable price compared to the market value. What is reasonable? Again, you need to analyze it on a case-to-case basis. Okay. Now, S for, once you classify an asset as held for sale, if conditions are satisfied, today you'll classify it as held for sale. No? Correct? Now, what Ind AS 105 says is, if you classify an asset as held for sale, from the today's date, within 12 months, the asset should be sold off. From the day a non-current asset is classified as held for sale, from that day, within 12 months, the sale must be completed. That's what they're trying to say. So, what if sale is not completed? That we will see next point. Okay. So, today, if conditions are satisfied, if these conditions are satisfied, and if you classified as held for sale means, you need to sell it within 12 months. Okay, sir, how will we know that, sir? That is like, if you need to ask the management, if the management is confident that they will sell the asset within 12 months, if the management is having the confidence that within 12 months they will sell the asset, then that is good enough for it. If the asset is not, eventually if the asset does not get sold within 12 months, what to do? Next provision. Okay, this is basically management intention. W for, again same, plan not to be withdrawn. Once you go ahead with this plan, it should be concrete, it should not be withdrawn. Again, if plan gets changed, plan gets withdrawn, what to do? We will do it in the next section. So if all these conditions are satisfied, then we say sale is highly probable. Along with that, if C is also satisfied, then a non-current assets gets accounted under Ind AS 105 as held for sale. That's all it is. Can we go ahead, people? There's some case studies, I think. Can we go ahead and look at that? Any doubt in any of these pointers? I think mostly common sense pointers, all these are correct. Okay, so let's maybe go ahead and see. All right, now there are some chinto pinto things. So look at this. So loss of control in subsidiary. Small concept. What is this? Okay, so now let's look at this. Now, people, when you have a subsidiary company, now we don't call it as holding subsidiary. In Ind AS, we call it as parent company and subsidiary company. Now, whenever we have a subsidiary company, parent will prepare CFS, consolidated financial statement. Now, in that consolidated financial statement, your parent will show their own assets and liability. Along with that, they will also show subsidiary assets and liability. That's how you prepare CFS. Yes, no, consolidated financial statement we have done in AS 21. At least the basic framework we know, correct? In CFS, consolidated financial statement, parent assets and liability as well as subsidiary assets and liabilities will be shown. You will add it up and show, correct? That's what consolidation in simple language means. Okay. Now, let's say parent has an intention to sell subsidiary shares. Let's say parent owns, let's say P Limited, parent, they own 90% shares in S Limited. P Limited owns 90% shares of S Limited. Okay, sir. Now, with 90%, you get control. When you have control, P becomes the parent company, S becomes subsidiary company. So, we need to prepare CFS here. Now, in the current year, P has an intention. P Limited wants to sell 90% shares. This 90% shares, whatever P Limited is owning, no, they want to sell it. Fine, they don't want to have the shares anymore, they want to sell it. Sir, once you sell the shares, will S Limited still be our subsidiary? After selling the shares, will P Limited and S Limited will they be still a subsidiary company? No. Correct? This we call it as LOC, loss of control. Okay, you did not have this in CA intermediate, it is there in your CA final. We will do this in consolidation topic. When control is lost, what to do? I'll talk about that. But for now, let's analyze this from Ind AS 105 perspective. Okay. Parent has not sold the share equity of subsidiary company, but they have an intention to sell it. Okay. Sir, Ind AS 110, like we had AS 21, no, which talks about consolidated financial statement. Here we have Ind AS 110, which talks about consolidated financial statement. Ind AS 110 says, till you have control, you need to prepare CFS. Now, still we are holding shares. No, we have not yet sold. Only we have an intention to sell it, but we have not yet sold. When you sell it, then there is something called loss of control accounting that will get triggered, but we have not yet sold. Okay, that means we still need to prepare CFS. Now, in CFS, parent ka assets and liability will be shown along with subsidiary ka assets and liability. Now, what Ind AS 105 says is, you have an intention to sell the subsidiary company soon now, no? Now, when you prepare, now, or maybe look at this example. If control is still there, let's say parent company, or maybe I'll make this as, instead of P, I'll make it as maybe H Limited only to kind of connect with this example. Let's say H Limited, that is the holding company or parent company. They have a building worth 2 crore. Subsidiary company S, they have a building worth 1 crore. Okay, fine. Now, when you prepare CFS, if control is still there, meaning if we have no intention to sell the shares, parent has no intention to sell the shares, meaning everything is going smoothly. So, in that case, when you prepare CFS, both this building will be shown in CFS under where? Under non-current assets. Under asset category, there is non-current assets. Under non-current assets, you will show building in CFS. At what value? 2 crore plus 1 crore, which is 3 crore. This is a normal scenario. Okay, but if LOC is expected, LOC means loss of control. If parent is expecting to sell the company, subsidiary company ka shares and lose out the control, then you have not yet lost the control, no, but we have an intention to sell. In that case, what you'll do is, how much is parent ka PP? 2 crore building. Only that will come under non-current assets. Only H Limited ka building will be shown 2 crore under non-current assets. Subsidiary ka assets, as I told, no, once an asset gets classified as held for sale, you can't show it in the main category, you have to show it separately. Now, subsidiary ka building, you will show it separately as a separate category or under current asset as non-current assets held for sale. This is the thing. So, it's not really a valuation, it is just the manner of showing the components in balance sheet. That's all it is. If things are good, you will display or you will show like this. If your LOC is expected, LOC means loss of control. Okay. Then you will show only parent ka assets under non-current assets. Subsidiary ka assets, we will show it under separate category called non-current assets held for sale. Here subsidiary ka building value is 1 crore. I've taken only one asset just to illustrate this example. Okay, now like this, every asset of subsidiary, you'll have to show it like this. That's all this is intention, or that's what is this para all about. Any point over here, people? Need some time to reflect on it, or next one? Like this, some 5-6 small concepts, then the remaining questions. Can I move forward? I think you must have already got this notes. Now I asked the teams to send it to you. Yesterday itself I asked. I hope you should have got it. Did you guys get it? Both Ind AS 36 ka and Ind AS 105 ka. Have you guys got it? The notes. This notes. Okay, fine. Superb then. Okay, let's move on then. Fine, people. So this is done. Okay, next small concept is, now people, if you remember, for a non-current assets held for sale, there are 7 conditions should be satisfied. What is that? C, P, M, B, A, S, W. C for it should be sellable in present condition. P for sale must be highly probable. M for management is committed to sell. B for active program to find the buyer is launched. A for asset is actively marketed at reasonable price. S, I want you to focus on S. What is S? Once you classify it as held for sale, within 12 months you need to complete the sale. That is S. W, plan not to be withdrawn. Now let's focus on that S wala. Once you classify it as held for sale, from that day, within 12 months, you need to sell off that asset. Okay. Now, there is a small exception to that. There is a small exception to that. As a normal rule, if you classify it as held for sale, within 12 months, you need to sell it. But sometimes the sale may go beyond 12 months. Entity is not able to sell that asset within 12 months. It went a little above 12 months. If we are not able to sell it within 12 months, there has been a delay. Okay. If there is a delay, if the period goes beyond 1 year, what to do? That is what this provision is trying to say. Okay, people. So if there is a delay, first question you will ask is, or maybe I'll tell you the provision. Even if there is a delay, even if the sale has not happened within 12 months, if it has gone beyond 12 months, if 2 conditions are satisfied, still you will show that asset as non-current assets held for sale in your balance sheet. What did I say? The sale has not been completed within 12 months. There has been a delay. The actual sale has gone beyond 12 months. Okay, fine. Even if there is a delay, still you will show that asset as non-current assets held for sale in balance sheet, provided 2 conditions are satisfied. What are those? 1, the delay must be beyond entity's control. The delay has happened not due to entity's fault, but due to some circumstance which is not within entity's control. I'll give you an example for this. Second one, the company or entity should still have an intention to sell the product. The company is still committed to that sale plan. Just because there is a delay, company should have not changed their intention to sell. Even though there is a delay, company is saying, still I have an intention to sell this asset. If both of these are satisfied, means you can continue to show that asset as non-current assets held for sale. Okay. Now let's go 1 minute and spend a little extra point. Let's understand this a little better. What are those 2 conditions? There is a delay, but that delay should be beyond entity's control. Look at this example. Now let's say, people, an asset got classified as held for sale on 31st March 2019. I've just taken a small example. Okay, with the dates, I'm trying to explain this particular first point. Condition was satisfied. CP, MBA, SW, that condition, no, it got satisfied on 31st March 2019. So a particular asset has been classified as held for sale. Now, one of the condition for you to classify it as held for sale is from the day you classify it as held for sale, within 12 months. Within 12 months, you should have sold the product or rather asset. So 31st March 2019, if you have classified as held for sale, means count 12 months from this date. 12 months from that date is what? 31st March 2020. So within 31st March 2020, we should have sold off this non-current asset. Now, unfortunately, we know what happened in 2020. Our great COVID Mahamari, COVID came. So let's say COVID came on 31st March 2020, meaning COVID was running in that period. Now, during COVID time and all, do you think we will be able to sell our asset? No. So because of that, by 31st March 2020, sale was not completed. We were not able to sell it. Now you tell me, there is a delay over here. Is this delay due to entity's fault or a circumstance beyond entity's control? COVID is not within anybody's control, no, right? It was something which is beyond every entity's control. So that is your first condition, is what it's trying to say. Though there is a delay over here, it is not due to entity's fault. It is due to some circumstance beyond entity's control. So if that is there, means it's okay. You don't have to change your classification. Still show it as non-current assets held for sale. So in this example, on 31st March 2020, asset is not yet sold. No, it is still there. Still on 31st March 2020, when you prepare balance sheet, you'll still show this asset as non-current assets held for sale. That's all it is. Now understood this condition better, huh? Okay. And second one is really common sense. Even though there is a delay, company still has an intention to sell it. If both are satisfied, a delay can be ignored and same classification as non-current assets held for sale will continue. Okay, I'm thinking you guys are good. Next is sale. So when we use, though the standard says non-current assets held for sale, the word sale here includes exchange also. Sale includes the normal sale, meaning sell the asset and recover the money. That is also considered as sale for Ind AS 105 purpose. Even exchange is considered as sale. Exchange means, let's say X Limited has a factory in Bengaluru. One company X Limited, they have a factory in Bengaluru. There is another company Y Limited. They have a similar factory but in Chennai. Now X wants to shift their operation from Bengaluru to Chennai, and Y, they want to shift their operations from Chennai to Bengaluru. Okay. So what X and Y said is, let's exchange our factory. Anyway, our operation scale of operations, everything is similar. So X and Y told, they did an agreement to exchange their facilities. Now X will use Y Limited ka factory going forward. Y will use X ka factory in Bengaluru. So this is not really a sale. It is a exchange, right? That exchange is also considered as a sale for Ind AS 105 ka purpose. Even this is acceptable. Okay. All right. That's all. That's all. Is one line over here. Next small concept is assets acquired exclusively with an intention to subsequently dispose. Asset which is acquired with the sole intention to sell it. Sometimes what happens, we will buy an asset with a sole intention to sell it off. Let's say we purchased a building. Company has purchased a building. Their intention is not to use this building. After buying it, they want to sell it. Their sole intention of buying a particular building is they want to sell it. Okay, that's the sole intention, because they feel they got a good price. Currently, they have found a building which they're getting a good price. So they're thinking, let's buy it now because we have some surplus money and immediately we will sell it off. Okay, that's their intention. Okay, that's what this provision is trying to say. Okay. Now people, if you have purchased any asset, any building or machinery or any intangible asset with a intention to subsequently dispose it, not with an intention to use it for business purpose. Our intention for buying this non-current asset is to sell it off only. Okay. If that is the case, means the time you buy it only, like in my example, company got a good deal on building and they have purchased it, right? Their intention of purchasing a building is to not to use that building for their business purpose, but to sell it off. Okay. So if that is their intention, means on the day the company purchases this building, the day the companies purchase this building, that day only you classify it as held for sale. Don't show it as non-current asset. If it is non-current assets, you will show it under PP or whatever, right? So if your intention of buying itself is to sell it off immediately, then on the day you purchase only, on the purchase date only, you classify this asset as a non-current assets held for sale and apply Ind AS 105 ka provision. That is one. Point number one. Comfortable? Okay. Now in these cases, for these assets, only for these assets, 3 months extra time is there given to satisfy this condition. Only for this assets, not for every asset. Only for this asset. This asset means those non-current assets which are purchased with an intention to sell it. Only for this asset, extra time. What is extra time? 3 months. That 3 months time is given to satisfy this condition. One of them, not all of them, in fact, the main thing is C over here. That's what they're trying to target. C. Focus on the C. What is the C? It should be sellable in present condition. It should be sellable in present condition. Now let's say a company has purchased a building. Okay, or I think it's there in the next page only, maybe instead of building an example, or maybe it's okay, no issues. Let's maybe build it up here. Now let's say company has purchased a building, okay, today, and their intention of buying a building is to sell it off. But before selling the building, company, they want to do some small renovations, like change the paint, okay, some interiors they want to change, something they want to do. This we call it as refurbishing, correct? It's there in the next example also, refurbishing, or some enhancement they want to do, some small changes they want to do so that the value of this building increases. Now to refurbish this building, to make this renovations and alterations, let's say company feels it takes 2 months for this painting, changing some interior, etc. Company is telling it may take about 2 months. Okay. Now, what is the company's intention behind buying this building? To immediately sell it. So, if that is the case, means extra time period, how much is that? 3 months extra time will be given for such companies to satisfy the condition. Actually, plainly, if you interpret Ind AS 105 ka condition, today you cannot classify this asset as held for sale. Do you agree with me? Plainly, if you interpret Ind AS 105, C wala condition is failed over here. Because what does C say? C says it should be sellable in present condition. But is this asset sellable in present condition? No. Company wants to make some changes to this building, which will take about 2 months. And then only they will go ahead with the sale. That means actual interpretation of provision says that it is sellable, it is held for sale only after 2 months. Okay. But the very intention of company buying this building is to sell it. Only for such assets, extra time is given 3 months. So within 3 months, if you are able to prove your condition, it's okay. Meaning today only you can classify it as held for sale. If it is going beyond 3 months, then no. 3 months time period is given for us to satisfy this condition. And here I'm saying the refurbishing time is 2 months. Is 2 months within 3 months? Of course. That means today only you will classify this asset as held for sale. Even though the renovation is going to take 2 months, you will not classify it as held for sale after 2 months, but today itself. Okay, sir. So it's 15 months. No. Jayant, we're talking about this one. In that way, if you interpret it, total period comes to 15 months. No. What we are trying to say is that mostly we are targeting about C. What does C tell, Jayant? It should be sellable in present condition. As it is, you should be able to sell it. That is your C. Correct? No. Correct. But in my example, the company wants to do some renovation. Renovation is going to take how much extra time? 2 months time. So literal interpretation means if you apply C, sellable in present condition. Today, is this asset sellable in present condition? No. Why? Because you want to do this alterations. This alteration is going to take 2 more months. Fine. So as long as this alteration is within 3 months, it is acceptable. That delay is acceptable. You'll still say that it is sellable in present condition and classified as held for sale. That is one extra shortcut or privilege is given for that. Okay. Yes, correct. So Agnesh is saying, sir, it is a 3 months time given to bring the asset to present condition. Yes, no, correct, Agnesh. Probably you can interpret like that better. 3 months extra time is given to bring the asset to the present condition. Okay, Jayant? 3 months extra time to satisfy C. Maybe we'll interpret like that. That is probably better. Okay, move on to the next then if you've got it. Next small thing is criteria satisfied. Criteria means that CPMBA-SW, that criteria, it has got satisfied. It is fulfilled, but not on the balance sheet date, but after the reporting period. that CPMBASW criteria is satisfied after the reporting period. In that case, what to do? Sir, didn't understand, sir. Okay, look at this. Let's say, sir, current year is ending on 31st March 2025. Current year is ending on 31st March 2025. So on the year ending date, you will prepare balance sheet. No, so I've written balance sheet date. Okay. Now that CPMBASW, one asset. Okay. Now there's a separate provision. Don't have the hangover of the previous one. Okay. There's a separate provision. Company has a building. Since many years, they're holding the building. Okay. Company is owning a building since many years. Let's say since last 5 years, company has this building and they've been using for their business purpose. Okay. Now on 1st May 2025, company has decided to sell this building. And all those criteria, CPMBASW criteria satisfied. On what day? 1st May. That CPMBASW criteria got satisfied on 1st May. Okay. That means on 1st May, ideally it is non-current assets held for sale. But we know, we have studied AS4 and all. Do you remember? AS4, contingencies and events occurring after balance sheet date. We studied about adjusting, non-adjusting event and all. So it is just a takeaway or extension of that concept over here. Let's say current year, though it ended on 31st March 2025, after the year ends, audit will happen. Then board of directors will approve the financial statements. Then then the AGM, the financial statements will be accepted by the shareholders in AGM, all that protocols. Now let's say this year ka financial statement got approved by board of directors on 31st July. This year ka financial statement got approved by the board of directors on 31st July. That means within the financial statement approval date, the criteria, CPMBASW criteria is satisfied. Within the current year financial statement has got approved, that is 31st July, that CPMBASW criteria is already satisfied. Now the question arises, should we treat this as adjusting event? You remember AS4? Should we treat this as adjusting event? And on 31st March balance sheet itself, should we show this as non-current assets held for sale? On the balance sheet itself, in this balance sheet itself, should we show non-current assets as held for sale was the pointer put forth. Okay, should we treat this as adjusting event and do that treatment? The standard is saying no. You will classify it as non-current asset as held for sale from the day the condition gets satisfied. Condition is satisfied only on 1st May, no? Is 1st May within current year? No. Current year is ended on 31st March. Criteria has got satisfied not in the current year but in the next year. So in the current year balance sheet date 31st March 2025, you cannot show this asset as non-current asset held for sale. But you can give a disclosure of this. In notes to you'll treat this as a non-adjusting event. For adjusting event, we do the changes. For non-adjusting event, we only give a disclosure, right? We studied in AS4. Here also it is there. In AS 10, it will come. All those are chin to pinto topics. We will take it much later. Okay. So basically, you will only give a disclosure. In the current year balance sheet, you will not show it as non-current assets held for sale. So that's what I've written here. It is a non-adjusting event. But meaning you will only give a disclosure. You will not change your classification. Meaning that building will be still shown as property, plant and equipment in this balance sheet. Till 1st May. From 1st May, from PPE category, you will change the classification as non-current assets held for sale. From 1st May, like that. Till 1st May, it will still come as a PPE in your financial statements. That's all is this provision all about. Okay. Just whatever I've written here as an example and all, it's good enough. No need to know all this provision or whatever I've underlined. If you just quickly review that, it's fine. Again, no need to mug up this. Conditions, if you remember, that is good enough. Rest everything, if you just know what to be done, that's fine. Because all this at best will come as a 1 or 2 marks ka case study question, where your final answer will probably, if you just know the right interpretation, in my view, that is enough. Okay. Non-current assets held for distribution. Sir, instead of selling the asset, if you are planning to distribute the asset to your members or shareholders, that will also attract Ind AS 105 ka provision. You need not really sell the asset to a third party. If your plans to distribute that asset to your members, then also Ind AS 105 ka same provisions will hold good. Normally we see this in private companies, no? In case of private companies, if a company has some assets like building and all, vehicles and all, instead of selling the asset to a third party, they may decide to give it to one of their members. So that is nothing but held for distribution. Instead of held for sale, we are holding it for distribution purpose. Distribution to whom? To the members. That will also attract Ind AS 105 ka provision. Okay, that's what. Yes, for this also Ind AS 105 will apply. Same provisions, valuations, recognition, disclosure, everything. Whatever we are learning, the same thing will hold good for this particular setup also. Absolutely no change. Next one. If a non-current asset is planned to be abandoned, we are planning not to sell it, but just to abandon it, scrap it. Can you apply Ind AS 105? No, people. If you want to apply Ind AS 105 ka provision, the very heading only is giveaway. Non-current assets held for sale. Held for sale. Abandonment is not sale. Abandon means we are not selling. We're just leaving the asset as it is. We now see, in some areas, the buildings are abandoned. They just leave the building and go away. Correct? So abandonment, non-current assets abandoned or not non-current assets held for sale. Because the very intention of Ind AS 105 is if you want to apply Ind AS 105, our intention is to sell this asset and recover the money. In abandonment, we are not selling and recovering the money. So hence, non-current assets planning to be abandoned will not be treated as non-current assets held for sale. So this will not come under Ind AS 105 ka provision. When you abandon it, write it off in P&L. If you're planning to abandon it, write it off. Transfer whatever the asset value is there, write it off and show it off in SPL. That's all it is. When it is abandoned. Clear? So it will not attract Ind AS 105 ka provision. That's all. That's all is the takeaway here. Okay, this one line is good enough. Okay, now comes the numerical aspect. Sir, if at all it is non-current assets held for sale, will the valuation change, sir? Is there any separate valuation measure or measurement basis for this, sir? Yes, sir. If an asset is classified as non-current assets held for sale, such non-current assets, okay, are valued initially as well as at every reporting period. Such non-current assets which comes under Ind AS 105 ka provision initially as well as at every reporting period are valued at carrying amount or fair value less cost to sell, whichever is lower. If today a non-current assets, if it is classified as held for sale, meaning if that CP, MBA, SW criteria, if that CP, MBA, SW criteria today if it is satisfied, means today that non-current assets will be valued at carrying amount or today's fair value less cost to sell, whichever is lower, like that. And the same valuation holds good for every reporting period also. A reporting period could be on an annual basis, or if company is following quarterly or half-yearly reporting period, that is also fine. At every reporting period, you will do the same measurement basis, like your biological assets basically. Yeah, but here the measurement is carrying amount or fair value less cost to sell, whichever is lower. Okay, that is point number 1. These are some measurement pointers. Next point is, sir, once a non-current asset is classified as held for sale, once a non-current asset is classified as held for sale, it will come under which standard? Suppose a building is classified as held for sale. Before it is classified as held for sale, you will apply Ind AS 16 ka provision. Okay. Once it is classified as held for sale, it will come under the ambit of, under Ind AS 105 ka purview. Same thing holds good for intangible asset. If you are using intangible asset, it will come under Ind AS 38 ka provision. If that intangible asset, if it is classified as held for sale, then henceforth the accounting of that Ind AS intangible asset will be as per Ind AS 105. And what Ind AS 105 says is, once a non-current asset becomes held for sale, we are not planning to use it, right? We are planning to sell it. Then depreciation stops. Depreciation stops. Because you are not getting any benefit. The reason for accounting depreciation is matching concept one way. You are using an asset means you are getting a benefit. When you are using a PP, you are getting a benefit. So correspondingly, due to usage, the value of the asset is reduced. So since you are getting a benefit and showing that benefit in SPL, right, the corresponding depreciation, you will show it as an expense because that's the related expense. That's what matching concept says, no? Income and its related expense should be accounted in SPL in the same year, in the same period as the benefit accrues. So, but here the moment the asset has been classified as held for sale, our primary intention is not to use the asset and get the benefit, but to sell it. Hence, Ind AS 105 says no depreciation, amortization on intangible asset. From the day you classify it as held for sale, depreciation stops. That we studied this in Ind AS 16 also, if you remember. If you open Ind AS 16 provision, there was a provision. Depreciation stops at earlier of 2 dates. The day asset gets classified as held for sale, on the day asset is de-recognized. Some provision was there over there, if you remember. But anyway, if you don't remember, no problem. But now the point you need to remember is, once an asset, non-current asset, is classified as held for sale, depreciation, amortization stops. No more depre, no more amortization. That is one. But all other things like interest on bank loan and all will continue. Meaning, if you have purchased an asset on loan, on loan you have to pay interest, no? The interest accounting and all will continue. You can't say, we'll stop interest now. Will banker agree? No, you still need to pay the interest. So all that finance charges accounting will still continue as it is. That's all it is. Okay, people. Next, one small pointer is, we have a problem on this, but quickly I'll just tell you what this is. Sir, now once a non-current asset is held for sale, how should you measure it? Carrying amount or fair value less cost to sell, whichever is lower. Correct? Okay. Now people, if the sale is expected to go beyond 1 year, not due to entity's fault, but due to circumstance beyond entity's control. Okay. So if the sale is expected to go beyond the 12 months, then you'll have to measure the selling expense at not the actual value, but at present value. You'll have to measure the cost selling expense at present value, because up to 1 year, we say time value money effect is not material. If anything is going beyond 1 year, we say time value effect is material. Hence, those components should always be measured at present value. So if sale is expected to go beyond 1 year, the selling expense, when you sell an asset, you might incur a selling expense, right? For measurement basis, we'll use cost to sell, right? That cost to sell will be measured at present value. The difference between present value and future value, you'll book it as finance charges. Now, how to target this? How to account to this? There is one question. We'll see it later. Okay. Fair enough, people. Don't worry much about this now. The question it will be taken care of. Okay. This is about measurement. You need a minute. Now, I think if you're good with this, then we can go for the numerical. I think we have done with almost all the concepts. Maybe only one is pending. Rest all problems. Yeah. 1 or 2 concepts is pending. That also is numerical based things. Any reservations? Anybody so far? Okay. Let's do a thing. Let's quickly recap whatever we have learned till here and then move on to the question side of things. Okay, first, the standard name is Ind AS 105, non-current assets held for sale and discontinued operation. We are right now in this category. Discontinued operations we'll learn in a bit. Leave that for the time being. Okay, non-current assets held for sale means our primary intention of the company is to recover the money, not by using the asset, but by selling the asset. That's our primary intention. Okay, all right. Once a non-current asset is classified as held for sale, it should be shown separately in balance sheet. Usually we show it under the current assets category. Okay. Disposal group means we are not selling one asset. We are selling a group of asset and liability. One group of assets and liability we are planning to sell it off, like a division. One division may have assets also, it may have liabilities also. If you are planning to sell a whole division, that we are calling it as disposal group. Okay. As a single plan or a single transaction, we are planning to sell a group of assets and liability. That's your DG. DG as in disposal group. Okay. Now, if you want to apply Ind AS 105 provision, 2 main conditions should be satisfied. What is that? The asset should be sellable in present condition and the sale must be highly probable. In order to prove that the sale is highly probable, we look for 5 more conditions. M, management is committed to sell. B, for active program to find the buyer is launched. A, for asset is actively marketed at reasonable price compared to fair value. S, sale to be completed within 12 months from the date of classification. W, plan not to be withdrawn. Okay. C, for sellable in present condition means the way asset is, as it is, you need to sell it. If you are planning to do some modifications and then sell it, then today you cannot classify it as held for sale. Once the modification, renovation, etc. is over, that day you can say it is sellable in present condition and classified as held for sale. That is one. Okay. Next, P. These are pretty common sense, so that's okay. Then what did we learn? If you're planning to lose control over subsidiary company, you have not yet lost the control over subsidiary, but you're planning to lose the control, then still you need to prepare CFS. But in that CFS, only parent ka non-current assets will be shown under non-current assets category. Subsidiary ka all the non-current assets, you will show it under separate category called non-current assets held for sale, like that. Okay. Next, exception to period 1 year. One of the criteria for Ind AS 105 classification is sale to be completed within 12 months. But if that sale is expected to go beyond 12 months, still the delay is acceptable under two circumstances. What is that? One, the delay should be beyond entity's control, and even due to delay, company still has an intention to sell it. Okay, that those two conditions. Next, sale for this Ind AS 105 purpose includes exchange also. Now, if you purchased any non-current assets with a sole intention to sell it, the very reason for you buying that non-current asset is to sell it. If that is the case, means 3 months extra time is given for satisfying the C. C means sellable in present condition. Even though it is not sellable in present condition, you can take 3 more months to satisfy this condition. And today itself, you will classify it as non-current assets held for sale. Okay. Next, what if the criteria, that CP, MBA, SW criteria, if it is satisfied not on the balance sheet date, but after the current year ends, but before the approval of financial statement? Means, sir, the day conditions are satisfied, that day only you can classify it as held for sale. So in the current year, if condition is not satisfied, means the current year, you will show it as a normal classification of PP, intangible asset. Like here, in this 31st March balance sheet, you will still show, if it is building, you will show it as under PP itself. If it is intangible asset, you will show it under intangible asset. Why? Because the criteria got satisfied on 1st May. 1st May is not current year, but next year. So current year, you only give a disclosure. Actual classification as non-current assets held for sale happens only in 1st May because condition has got satisfied on that day. Okay, instead of selling, if you're planning to distribute the asset to members, same provisions, whatever we're learning, will hold good. Then, if you're planning to abandon a non-current asset, it will not attract Ind AS 105 ka provision, meaning it is not a non-current asset held for sale. Then the measurement. If you have any non-current assets held for sale, initially as well as at every reporting period, it will be measured at carrying amount or fair value less cost to sell, whichever is lower. And once you classify it as held for sale, such tangible and intangible assets are no more depreciated or no more amortized. Okay, but as other expenses continue. Okay, G. That's all we have done so far. Now, can we get to the numerical questions? Okay, come to question number. I think we have one question. Where is that? Where? This people. Come to question number 7. We'll do this. It's based on the criteria. Now, it's a theory question, one-liner answer. You give me the answer. I'll read out the question for you. This is an LDR. You can expect these sort of questions also come for 1 or 2 marks. So hence I'm making this as an LDR. Okay. Now look at this. A Limited is one company. They want to sell a non-current asset. That is land. Okay. Is to sell. Is to sell means not yet sold. They have an intention to sell this land. Okay. The piece of land has been contaminated. But this land is contaminated and will require entity to carry out 1 lakh worth of work in order to rectify the contamination. Maybe we have thrown in a lot of waste into this land, and maybe government requires us to clean up this whatever contamination we have done. We need to rectify that, and to rectify that, how much cost will have to be spent? 1 lakh. Okay. If the land was not contaminated, then it can be sold for 3 lakh. But current case, it is contaminated. Okay. With contamination, it is only worth 2 lakh because 1 lakh will go for your repair work, or rectification work, right? Without contamination, value is 3 lakh. But contamination is there. That means its worth is only 2 lakh. The work that is needed to rectify the contamination will extend the period of sale by 1 year. Due to this rectification work, you will not be able to sell the land within 1 year, they're saying. It may go beyond 1 year is what they're saying. Okay. So that means it is not getting sale will not be completed within 12 months. It will go beyond 12 months. This is the base data. Okay. Now you need to apply Ind AS 105 ka provision under 3 situations or under 3 cases. They've given 3 cases. For all the 3 cases, we need to tell whether we will classify this asset as a non-current asset held for sale or not. That's all you need to tell over here. Oh, look at the first case. Land is marketed for 3 lakh. People, with contamination, its worth is only 2 lakh. But company is marketing it for 3 lakh. Okay. A Limited company, they're saying, was not aware of contamination till the time a firm purchase commitment was signed with the purchase. Here in first case, they're saying we are marketing this land at 3 lakh. Why? Company is saying I was not aware of this contamination, because sometimes it could be chemical release and all sort of contamination, or it may be underground. So we may not be aware. So company is saying genuinely we were not aware of contamination. So we marketed it for 3 lakh. We got aware of this contamination when buyer did some survey. Maybe buyer did some survey on the land, because normally when you buy an asset, you'll do a thorough survey, no? Legal documents you will check, other things also you will check. So we got to know about contamination only when we received a purchase commitment order. Once we signed the sale agreement with the purchaser, then only the company A became aware that there is a contamination. The purchaser found the contamination through a survey. Okay. The purchaser signed the firm purchase commitment on a condition that contamination damage will be rectified. So in this case, what? People, you tell me, were we aware of it? As a company, were we aware of contamination? No. That means when we marketed the product, we were absolutely not aware of contamination. And now, because of contamination, we may not be able to complete the sale within 12 months. The sale will go beyond 12 months. But are we aware? No. Since we were not aware, is it our fault? No. So that means in the first case, though the sale is expected to go beyond 12 months, the classification will be still what? Since the entity was not aware of contamination, the land still will be classified as held for sale. Okay. Now, what if the entity is aware? That is the next case. Hang on to that. You don't have to think. Yeah, they have only made all that thinking. They have put it as 3 situations. First situations, are we comfortable? Since we were not aware, we marketed at a proper price, and we still thought that the sale will be completed within 12 months. So, from our point of view, all conditions are satisfied. So, still you will classify it as held for sale. The delay, because of the delay, we will not change the classification under situation 1. Okay, now look at situation 2. A limited company marketed the land for 3 lakh, knowing about the contamination when the proposal to sell the land went into the market. So, second situation where they're telling we were aware of contamination, we know about it. Still, we sold it for 3 lakh. I mean, rather still, we are marketing it for 3 lakhs. However, A limited marketed it with an agreement that it would carry out the rectification work within few months from signing the purchase agreement. So we are marketing the product for 3 lakh, and we are telling the buyer, once we make the sale agreement, A limited is saying, I will only rectify it. That means in this case, maybe, well, we are aware of it. And we are also aware that because of rectification, we will not be able to sell it within 12 months. It goes beyond. That means today we cannot classify it as held for sale. Today it is not available for sale in present condition. So in second situation, you cannot classify it as held for sale because we are aware of contamination. Due to this contamination, we will not be able to sell it within 12 months. It will go beyond. That means the day that rectification work is completed, then only C condition. What is that C condition? Sellable in present condition. That C wala criteria will be satisfied only when the rectification work is completed. That day you can classify it as held for sale, not today. Today it will still be shown as a non-current asset, and Ind AS 16 only shall apply and not Ind AS 105 in the second circumstance. Okay. All right. Third situation. A limited knew the contamination. We are aware of contamination. Prior to the float the proposal of sale, we are aware. Before selling only, we know that there is a contamination. And now company is marketing this for 2 lakh. A limited is wanting to sell this land for 2 lakh with no obligation on itself to rectify or fix the contamination. Now company is saying, we want to sell this land for 2 lakh and we are telling the buyer, boss, there is contamination. I will not rectify the contamination, you only do. So that rectification work, no, A limited is saying, I will not do it. We are telling the buyer, you only do it. On that condition, we are selling. Now you tell me, rectification should we have to do? No, we have passed on to that obligation entirely to the buyer. And with rectification, the value of that land, the fair value of the land is only 2 lakh. And we are marketing it also for 2 lakh. So now since we don't have to rectify, for us, for A limited, it is available for sale in the present condition. Because we don't have to rectify. Buyer will do that work. That means in the third situation, what is it? The condition is satisfied, so it will be classified as held for sale. That's all you need to write. One liner answer. Over. Question number 1, over. Done? Okay, sir. Now let's take up the remaining questions. Come to question number 1. Question number 1, where is 1? No. Yeah. This is about measurement, numerical questions. Now let's recap that measurement principle for us. Once a non-current asset is classified as held for sale, it will be measured initially as well as at every reporting period at carrying amount or fair value less cost to sell, whichever is lower. That is point number 1. Depreciation amortization will come? No. From the day it is classified as held for sale, depreciation amortization stops. Fine. With that in mind, let's read this question number 1. A Limited acquired a property, purchased a property at 2 lakh. So this is your original cost. After few years, cumulative depreciation is 80,000. So far, we have depreciated this asset by 80. So what is carrying amount? We bought it for 2 lakh. We have depreciated 80, means the carrying amount is 1,20,000. Okay. Okay. Subsequently, the property is classified as held for sale. Now they are saying in the current year it is classified as held for sale, and the fair value less cost to sell is 1 lakh. So now Ind AS 105 conditions are satisfied. Once Ind AS 105 conditions are satisfied, this particular asset should be valued as per Ind AS 105. Correct? It is no more Ind AS 16. We'll have to apply Ind AS 105. And how does Ind AS 105 recommend? What recommendation for measurement is acceptable? Carrying amount or fair value less cost to sell, whichever is lower. What is the carrying amount? 2 lakh minus 80,000, which is 1,20,000. On the day of classification, we need to find carrying amount. That is 120. On the same day, on the day Ind AS 105 first time is applicable for you, that day we need to find fair value less cost to sell. It is given to be 1 lakh. So this asset will be measured at 120 or 1 lakh, whichever is lower. Which is lower? 1 lakh. So this non-current assets held for sale will be shown in your books at 1 lakh. Okay. But hang on. Carrying amount means the value currently in our books. So currently the value in our books is 120. But from now onwards, we have to show the asset at 1 lakh. Correct? So currently it is shown at 120. From 120, we need to bring it down to 1 lakh. So that means there is a reduction of 20,000. That 20,000 reduction we accounted as impairment loss. From 120, you need to bring it to 1 lakh, right? There is a 20,000 reduction. That decrease we accounted as impairment. But this impairment is not as per Ind AS 36. This is shown as impairment as per Ind AS 105. This is booked as impairment loss, but as per Ind AS 105. How much? 20,000. And that will go after SP. That's all is initial drama. Clear, Sarji? This is your accounting. Fine. Okay, they've given some other points. Let's read it there. On the next reporting period, fair value is 85,000. Now they're saying possible, no. Excuse me. If an asset is getting classified as held for sale on 31st March, or maybe like, if an asset got classified as held for sale on 31st March 2035, anyway we have 12 months, no? Anyway we have 12 months, because one of the criteria for you to apply Ind AS 105 is within 12 months you need to sell the asset. Even if the sale goes beyond 12 months, if the delay is beyond entity's control and if an entity still has an intention to sell it, we will ignore the delay. So 12 months from this date will be 31st March 2036. So you might have 2 reporting period. Okay. So it's possible that you might have 2 reporting period. Or if company is following quarterly reporting, immediately after 31st March, 30th June 2035 will become another reporting period, right? So that's what they're saying here. In the next reporting period, after this, this is your initial recognition. This is your initial recognition. On the day asset got classified as held for sale. On the next reporting period, the fair value has become 85 there. Okay. Now what to do? Sir, we already know that as per Ind AS 105, initially as well as at every reporting period, we need to measure non-current assets held for sale at carrying amount or fair value less cost to sell, whichever is lower. Okay. On the previous reporting period or initially, a non-current assets now is shown at what value? 1 lakh. Now when the reporting period came, again we need to remeasure at what? Now the carrying amount of non-current assets held for sale is 1 lakh because you changed it. No, from 120 you made it to 1 lakh. Now again next year on the next reporting period, the carrying amount of non-current assets held for sale is 1 lakh. Sir, why 1 lakh, sir? Depreciation will be there, no, sir? No. Once an asset gets classified as held for sale, depreciation, amortization will not come. So if it was 1 lakh in the previous reporting period, on the next reporting period also carrying amount will be 1 lakh. But on the same next year reporting period, fair value less cost to sell has become 85. They gave. So what should be measured at? Carrying amount or fair value less cost to sell, whichever is lower. Which is lower? 85. So in the next reporting period, this non-current assets held for sale will get measured at 1 lakh. But before this drama, non-current assets held for sale ka carrying amount was 1 lakh, right? Now from 1 lakh, you need to bring it to 85. From 1 lakh, again, you need to bring it to 85. How much is the reduction? 15,000. That 15,000, you will book it as impairment loss. But as per Ind AS 105, that's what I've written here. Impairment loss as per Ind AS 105, which goes off to SPL is 15,000. That's all it is. So the revised carrying amount. The revised carrying amount from 1 lakh, you'll book impairment loss of 15 and the revised carrying amount will become 85,000. That is the next reporting period. Clear, sir? And finally, what they said, and the asset is sold for 90,000. In the next reporting period, first the fair value became 85, you remeasured. After that, when did we sell? They had not given the date. Okay. Finally, we sold the asset for 90,000. Now, when you sell the asset, what you will do? Can you show the asset? No, you need to cancel it. The carrying amount of that asset is 85,000. Finally, final carrying amount of that asset is 85. We sold it for 90. 85 worth of asset, if you sell it for 90, we will make a gain. No, that it's a realized gain, goes off to SP. That's all is this question. Easy na, sir? Any problem, sir? This question number 1 is Damar according to me. If you need a minute, if you need some time, I will wait. If you have got it, we shall move forward. Forward marcha, what do people? Some response would be nice. So from online, no? Yes. Need some time. Wait or next question. Next question. Tell, sir. If you're writing, I'll give you time, no problem. But you do let me know. Okay, fine, people. So moving along. Now, people, if you remember, in Ind AS 36 May, we studied previously only, yesterday only, we can book impairment loss and we can also reverse impairment loss. But all that booking of impairment loss was based on indicator. Reversal of impairment loss was also based on indicator. That is as per Ind AS 36, right? Now here, in this problem also, if you just check, we have booked impairment loss, 20,000 initially, another 50,000 on the next reporting period. Can you reverse that impairment loss is what is this particular concept. Yes, sir. Ind AS 105 says, yes, you can reverse the impairment loss. Whatever impairment loss you have booked, right? If you have booked impairment loss initially or on one reporting period, in the subsequent reporting period, reversal of that impairment loss is also acceptable. How? Let's understand this through small example here. So they've explained it in words. I've tried to put it across in numbers. Numbers are much better. Check here. Let's say in the year one, carrying amount of a particular non-current assets. Let's say building. Building ka carrying amount was 1 lakh. But it got classified as held for sale. Condition got satisfied. CP MBA SW. That condition satisfied. That means henceforth you need to measure that asset as per as Ind AS 105. And Ind AS 105 says non-current assets held for sale should be measured at carrying amount, that is 1 lakh, or fair value less cost to sell, whichever is lower. I've assumed the fair value less cost to sell to be 85. I've assumed the numbers just for explanation purpose. Carrying amount 1 lakh, fair value less cost to sell 85. Which is lower? 85. Currently asset is shown at 1 lakh. So you will book on the initial recognition, you will book an impairment loss, but this impairment loss will be as per Ind AS. This impairment loss will be as per Ind AS 105. Impairment loss as per Ind AS 105 is 15,000. Correct? And when you book the impairment loss, carrying amount will get revised. From 1 lakh, the carrying amount will become 85,000. That's your revised carrying amount of non-current assets held for sale. Correct, sir? This is your IR. IR as in initial recognition. Initial recognition. Now, possible that we may follow quarterly reporting period or yearly, whatever. So in the next reporting period, I'm calling it as year 2, right? In the next reporting period, what is the carrying amount? Since once it comes under Ind AS 105 provision, will you depreciate this building? No, you will not depreciate. That means carrying amount will be still how much? If it was 85 in the initial recognition means, in the next reporting period also carrying amount will be 85. Okay. But when the reporting period comes, at every reporting period, non-current asset should be measured at carrying amount or fair value less cost to sell, whichever is lower. Now in the next reporting period, let's assume fair value less cost to sell has become 105. Possible, no? Fair value may increase or decrease based on market condition and so many other factors. So let's say fair value less cost to sell has become 105. So how should you measure this non-current assets? Carrying amount or fair value less cost to sell, whichever is lower, correct? So carrying amount is only lower. That is one. But hang on. Now people, you are showing the asset in books at 85, but its fair value less cost to sell is 105. What is the difference of these two? 20,000. That looks like a gain because you are showing 85, but you can sell it for 105, means it looks like a gain. Not realized, but it's a gain, correct? Will you book this 20,000 gain? Huh? No. You'll not book this 20,000 gain. But you can't book this 20,000 gain. But whatever impairment loss you booked previously, how much impairment loss you booked previously? 15,000. Now, is this loss really there? No, you have got a gain. It's not really a loss, correct? It's a 20,000 gain. You cannot book this gain because it goes against measurement principle. But whatever impairment loss you booked initially, that you can reverse. So that's what I'm written over here. Impairment loss, you can reverse 15,000. We already know when you reverse impairment loss, carrying amount will increase. From 85,000, 15,000 impairment loss you have reversed means the revised carrying amount will become 1 lakh. That's all this is funda. So that means the initial 1 lakh will be restored back. That's all is a funda. So in one reporting period, you can book an impairment loss. In the subsequent reporting period, may fair value increases compared to carrying amount, if fair value increases. So previously, whatever impairment loss you have booked, that can also be reversed over here. It's a straightforward reversal. How much ever you have booked previously, maximum that much you can reverse. That's all this is funda. That's what they're trying to say in this particular as words. That's all. I think this numerical thing is good enough for us. This is just an example, huh? Not really a question. Okay, Sarji. Next question, Sarji. Question number 2. Chudama, Paklama, Nodanva. Okay. Question number 2. This is about disposal group. Disposal group. Disposal group means what, sir? We already went through its meaning. Disposal group means we are not selling one asset. We are not selling one asset, but a group of assets and liability we are selling as one transaction. Group of assets and liabilities we are selling as one transaction, like a division sale, not a major division. Let's say a small division, whatever, major, minor, whatever. If you are planning to sell off a division, not the whole company, but only a division. Like let's say if ArivuPro, if we decide to sell CS division, CS, company secretary division, then that CS division will have some assets. It'll have some PPs also. It'll have some intangible asset also. It may have some current asset like debtors also, cash also. It may have some liabilities like creditor, bills payable also. So that division ka assets and liability, we call it as disposal group. And now we are not selling individual assets. One by one we are not selling. Whole group, that disposal group or that division itself we are selling. So this is a question based on that. So let's see. It's an example in study material. I've converted into question. So let's see. Disposal group is classified as held for sale. Fair enough. Now once we already know, once a non-current assets gets classified as held for sale, what is the measurement principle? Initially as well as at every reporting period, it will be measured at carrying amount or fair value less cost to sell, whichever is lower. Okay, keep that in mind. Fair value less cost to sell of this disposal group is 13,000. On the day you classified it as held for sale, that group ka, not one asset ka, that disposal group ka fair value is, or rather fair value less cost to sell is 13,000. Okay, then they've given a table. This disposal group has all this asset. All this put is that group ka asset. We have goodwill, we have PP, building or inventory, investment to blah blah. Fine. All this put together is one group of asset. There's no liability. Sometimes you can have liabilities also, no problem. Okay, now check this. They've given carrying amount at the reporting date. On the reporting date, they've given carrying amount, and this reporting date is before it got classified as held for sale. This is not the carrying amount on the date it got classified as held for sale. Before it got classified as held for sale, there's one reporting period. Let's say like this. Excuse me. On 31st March 2035, 31st March is usually reporting period. No, that day ka carrying amount they have given. Let's say this disposal group became held for sale. That criteria got satisfied on, let's say, 31st March 2035. On 31st March, the criteria got satisfied. Okay. Have they given, if I assume these two dates, now what sort of carrying amount have they given? Have they given carrying amount on 31st March? No. Here they're trying to say this is a carrying amount on the reporting date before it got classified as held for sale. That means this 31st March ka carrying amount they've given. Okay, fine people. This we don't need. For measurement principle, we want carrying amount on the day it got classified as held for sale. But here they have given carrying amount on the reporting date. So this is absolutely irrelevant for me. Look at the next Bajuwala column. Carrying amount as remeasured immediately before classifying as held for sale. Immediately before. Just before you classified it as held for sale, this is a carrying amount. That means what? This column is relevant for us or this column? The second carrying amount is a carrying amount on 31st March 2035 in my example. So this is the relevant number to us, which is what? 14,900. I know people, some students will say, sir, this date ka carrying amount is 16,000. This date ka carrying amount is 14,900. So it has reduced. 16,000 has become 14,900. Reduction is 1,100. Book it as impairment loss. As per Ind AS 105. Punyatma, don't do that. This 1,100 is not impairment loss. See, impairment loss as per Ind AS 105 will come on the day you classify it as held for sale. Correct? So, 16, this is what? All this 16 to 14,900 reduction. This reduction 1,100 is before Ind AS 105. Before Ind AS 105 is applied, before Ind AS 105 applies, before that only 1,100 asset is reduced. So, that could be your revaluation loss or respective Ind AS ka loss. You accounted as per respective Ind AS. Whatever that respective Ind AS is, account as per that. Okay, fine. So this you will not book it as impairment loss as per Ind AS 105. Getting the meaning? Everybody got it? So that means this number, you don't have to worry about that. Just saying, if you have that thought, don't book this as impairment loss. This is loss to be accounted as per respective Ind AS. Like goodwill. Goodwill, you may, if there is any reduction, you'll account it as per Ind AS 103 ka. If PP may, if there is any reduction, you'll account it as per Ind AS 16. Building, no reduction. Inventory reduction accounted as per Ind AS 2. Investment is a financial asset. We'll apply Ind AS 109. So basically, this 1,100 reduction will be accounted as per the respective Ind AS. And it is not an impairment loss as per Ind AS 105. That is point number 1. Okay. Now, once a disposal, an individual asset can get classified as held for sale or even a group can get classified as held for sale. The provision Ind AS 105 will apply for group also, individual asset also, same provision. This is the disposal group, but it has satisfied held for sale criteria. No? Whenever it satisfies held for sale criteria, we'll have to measure initially as well as at every reporting period. What is the measurement principle as per Ind AS 105? Carrying amount 4,900. Or fair value less cost to sell, whichever is lower. On the day or immediately before an asset got classified as held for sale, what is the carrying amount? 4,900. What is the fair value less cost to sell? 13,000. So lower of the two. That's what I've written over here. Check. Solution easy. Only all these are very, very simple questions. In fact, same thing what you did in Ind AS 36 also will hold good over here. Check. The carrying amount of DG. DG means disposal group. On the date of classification or immediately before classification, it is given this number. Second table wala column 14,900. I copied that. Then fair value less cost to sell. First para only they gave 13,000. So this disposal group DG will be measured at 14,900 carrying amount or fair value less cost to sell, whichever is lower. Which is a lower amount? 13,900. Correct? Okay. So you will measure this disposal group at 13,000. Fine. But currently the carrying amount is 14,900. You'll have to measure it at 13, but current carrying amount is 14,900. So there is a reduction. That reduction you will book it as impairment loss as per Ind AS 105 to SPL. How much? These two car reduction 1,900. Correct, sir? Fine. In the first question, what we did, it was individual asset. It was one asset. So this impairment loss, you will assign it to only one asset. Yes, because Ind AS 105 applies to individual asset also, group of asset also. First problem what we did was individual asset ka Ind AS 105 ka provision. Now here it is not individual asset, it's a DG, disposal group. Group means you have multiple assets, right? So that means it is like CGU. You remember Ind AS 36, we did CGU. CGU means group. So this 1,900, sir ji wo chahiye. सर जी hello चाहिए चाहिए थैंक यू हाँ रहने दीजिए आई थिंक दूसरे क्लास से now this 1900 is an impairment loss accounted as per Ind AS 105, but this is not impairment loss on one asset. This is an impairment loss of the DG disposal group. Whole group ka impairment loss is 1900. Got it? So since this is not impairment loss relating to one asset but multiple assets, what we need to do? We need to allocate. Same allocation what you did in CGU ka impairment loss you allocated na. Same thing. How did we do CGU ka impairment loss allocation yesterday? Maximum possible impairment loss, first we will assign it to goodwill. Balance to the other assets in carrying amount ratio. Other assets means only property, plant and equipment. OOPs, investment property, intangible asset. No, same thing here also. So this 1900 impairment loss, first maximum we'll try to assign it to goodwill. Check. Does this group have a goodwill? Yeah, it has goodwill. How much goodwill it has? 1500. So that means out of 1900, 1500 will be assigned towards goodwill. Still impairment loss is there. Huh? Yes, balance is how much? 400. Balance you will give it to other assets. Sir, here in this disposal group, we have inventory, we have investment. Impairment loss, you will assign it to inventory and investment. Huh? No. Same as Ind AS 36. You'll only give it to your owner occupied property, investment property, intangible asset. So here intangible asset is not there, only tangible is there. So that balance 400 impairment loss will only be assigned to PPs and building. Okay. In what ratio? In their carrying amount ratio. Don't take this carrying. Before classification as held for sale, what was the carrying amount? 4000, and this column is not at all relevant for us people. The only column relevant is this. So balance impairment loss will be given to these two assets in 4000, 5700 ratio. Balance is how much? 400. 400 you will give it to PP in building in 4000, 5700 ratio. So distribute this in this particular ratio. So if you calculate 400 into 4000 divided by 9700, one out of this 400, 165 will be allocated to the PP. Balance will be allocated to the building. That's all. Okay, sir. Now once you assign impairment loss, the carrying amount will be same. No, it will reduce. So that is what they've shown it here. But 1 minute. In this particular allocation, this is same as Ind AS 36 what we did. Any doubt anybody has or comfortable? Ditto, not one bit change of Ind AS 36 and Ind AS 105 here. Comfortable now. One more table we'll have to do it. Then this question is over. No comments. That means I'll take it as good. Okay, once you book impairment loss, carrying amount will be same. No, it will reduce. First copy the carrying amount as given in the question. This carrying amount is there, no? Let's copy it. That's what I mean, yeah, the presentation. You can do your presentation whichever you want. This number, 1500, 4000, 5700, 2200, 1500. That's what they've copied it here. Okay, this is before impairment loss. How much impairment loss you booked in goodwill? 1500. So goodwill will reduce by 1500. So revised carrying amount will become 0. After impairment loss, carrying amount will reduce. No? So goodwill becomes 0. For PP, how much impairment loss did you assign? 165. Before impairment loss, it was 4000. You are assigned 165 impairment loss. Carrying amount will become 3835. For building, you assign 235 impairment loss. Before impairment loss, this number, this is the impairment loss. After impairment loss, it will reduce. For inventory and investment, we will not assign any impairment loss, so the amount will be same. And the revised carrying amount will become 13,000. That's what we have written here. You'll have to measure it at carrying amount or fair value less cost to sell, whichever is lower. No, which is lower? 13,000. That's what has happened. The final number after all this drama, the final, the carrying amount of this disposal group on the day it got classified as held for sale is 13,000 rupees. Clear, Sarji? Okay. Actually, problem ends over there. They just, since this is an example in study material, they've given one more data and they've just continued this example. This is the initial recognition. This is the initial recognition. Now there could be some subsequent recognition also. So that they have so told. Suppose at the end of the reporting period, just an example, they've continued the data. Suppose after initial recognition, if any reporting period comes, and on that reporting date, fair value less cost to sell is 15,500. Suppose the fair value less cost to sell has now become 15,500. What to do? That's what they're saying. Done, people. Now we know initially as well as at every reporting period, non-current assets held for sale as well as disposal group should be measured at carrying amount or fair value less cost to sell, whichever is lower. So in the initial recognition, what is the carrying amount of disposal group? 4,900 or 13,000, whichever is lower. 13,000, you already know. Here also, this table is also giving. So next, when the reporting period comes, carrying amount of disposal group is 13,000. Okay, depreciation will not come because once an asset gets classified under Ind AS 105, depreciation, amortization stops. So carrying amount will be 13,000. But what about fair value less cost to sell? They're telling fair value less cost to sell is 15,500. I mean, there is a gain. Carrying amount is 13,000. If you sell, you will recover 15,500. So there is a gain, 2,500. You will book a gain. No. Non-current assets held for sale, disposal group. Whether you're doing individually or group level, they measured at carrying amount or fair value less cost to sell, whichever is lower. So gain you cannot book. But hang on. Whatever impairment loss you booked previously, can you reverse it? Yeah, you can't book this gain. But if you booked any impairment loss previously, that you can reverse. That is permitted. How much impairment loss did you book previously? 1,900. That you can reverse it. Impairment loss booked earlier is 1,900. That you can reverse. When you reverse, carrying amount will increase. From 13,000, carrying amount will increase by 1,900 and it will become 14,900. Because the reversal of impairment loss acceptable. Correct, Sarji? Yes. Okay. Now one doubt you should ask me over here. This is ICAI solution. Now one doubt you should ask me over here. What is that one doubt? Tell me. Let's see. You should have one doubt. If you remember Ind AS 36, you should have one doubt here. What is that? Perfect. Harish is saying, sir, goodwill impairment loss. Sir, in Ind AS 36, you told if you book any impairment loss on goodwill, you cannot reverse it. Because if you reverse impairment loss on goodwill, it becomes self-generated goodwill, which is not permitted to be accounted. But here in this problem, out of 1,900, 1,500 impairment loss was relating to goodwill. I mean, this, should you reverse it? Ideally, no. I'm telling my opinion over here. This is ICAI solution. I feel this is error. This is an error. Okay. But this is what they have told. I think it's an example. So probably ICAI kind of ignored it. But just to match what they have told, I have solved like this. But my opinion is this 1,500 impairment loss, you cannot reverse because it relates to goodwill. If you reverse this, it becomes self-generated goodwill. They have told that in provision, but still they told impairment loss 1,900 reversal is allowed. Whatever impairment loss 1,900 you booked, that reversal here they're telling it is allowed. Next line they're telling reversal of impairment loss on goodwill not allowed. So I think there is a clear typo over here from ICAI. According to me, the solution should be this impairment loss on goodwill you cannot reverse. How much is the other asset ka impairment loss you booked? 400. So the maximum impairment loss allowed should be only 400. So that means revised carrying amount should become 13,000 plus 400. It should become 13,400. This is my opinion. Okay, but this is what ICAI solution is telling. According to me, this is typo because they have given controversial thoughts over here. So according to me, this is the right solution. Understood? Okay, na Harish. Thanks for pointing that for me. So maximum impairment loss reversal allowed should be, in my opinion, 400. Okay. So only 400 you will reverse and get the carrying amount to 13,400. This is my interpretation. Okay. So no comment. So move on to next question. 1 or 2 more questions I will do and give you a break. Fair enough. No? Numerical questions. We can take care. 8 o'clock. Can we take that as a break time? Another 20-25 minutes we can pull through. Okay, next what? Next this one, or maybe hang on, maybe before this. Okay, or else maybe it's fine. I think we can do this and move on. It's okay. Now, people, what if the plan changes? What plan? The plan of sale or plan to sell the asset subsequently has changed. Now let's go one step back. So for you to classify a non-current assets held for sale, we look for CPMBA SW. There's a criteria. The day criteria gets satisfied, we will book it as held for sale. Now focus on this S. Or maybe leave this, it's okay. Well, whatever, I think not S, just alone that. Okay, let's maybe just look at it as a general provision. Now people, if all this criteria is satisfied, you will classify it as held for sale. Correct? Now, let us say on 1st January 2036, CP MBA SW criteria satisfied, criteria passed, fulfilled. Okay, that means you will apply Ind AS 105, and as per Ind AS 105, you will measure the asset at carrying amount or fair value less cost to sell, whichever is lower, and accordingly you will book impairment loss if it is required. Correct, Asarji? This is your accounting. If criteria is satisfied, then it will be accounted as per Ind AS 105, and this is how you will measure it. Correct? Now let us say on 1st March 2036, on 1st March 2036, plan changed or sale plan cancelled. Sale plan cancelled. Possible, no? Because business is very dynamic. There is, one of the criteria is plan not to be withdrawn. Management should have an intention not to withdraw the plan. Let's say on 1st March, company thought that they will sell a machinery. They will sell the plant and machinery. They were pretty clear on 1st March that yes, we will sell it. Okay, we have no intention to use it. But on 1st March, company started facing some financial difficulties. They lost some key employees, key directors, some cases were filed against them. So like this, some financial difficulties came on 1st March. So company, though they want to sell it, they feel they want to sell this asset and buy a new asset. But now they feel due to financial difficulty, we may have to continue to use this asset for 2 more years. So now the sale plan continued or it cancelled? It got cancelled. It's possible, no? Because anything can happen in business, right? Now on 1st March, the plan to sell this non-current asset has changed. We don't want to sell this asset anymore. That is what we are about to study. If this happens, so on this date, 1st March, what should we do? On 1st March, what should we do? Okay. Everybody good? Now maybe first I'll tell you in my own words there. First people, currently you are showing this as what? Let's say it's a building. Let's say this particular asset that we're talking about is building. On 1st January, when that CP MBA criteria, when it is satisfied, can you show this as building and accounted under PP? No. You will have to show this building where? On 1st March, you will show this building as non-current assets. You will show this building in balance sheet as non-current assets held for sale, HFS. You will put it under that category. You will not show this building under PP anymore. On 1st January, if you prepare balance sheet, it will come under this category. Agreed? Okay. Now, on 1st March, or you can also keep it as 31st March. It's okay. On 31st March, if the sale plan got cancelled, means what you have to do? Going forward, on 31st March, will you still show this asset in your balance sheet as non-current asset held for sale? No. You will have to change the classification. From non-current assets held for sale, you will show this as a non-current assets under PP. So you will show it as PP. Okay. Fine, people. So this is the first observation. So you need to change the classification of the asset. From non-current assets held for sale, it will come to the PP category. It will come to the non-current assets for a category. That's a category change you will do. First point is that. Sir, is there any impact in value? Yes. If your sale plan has got cancelled, if you no more have an intention to sell it, even the measurement should be changed. Measurement also should be changed. This is same as, for our remembrance sake I'm saying, this is same as, you remember CGU ka reversal of impairment loss ka rules? CGU ka reversal of impairment loss ka rule? Same limits here also. If you remember in Ind AS 36, yesterday we discussed, when you reverse impairment loss, carrying amount will increase, right? Can it increase to any amount or there is an upper limit? Upper limit. For CGU, there are 2 upper limits. What is that? There we said, if impairment loss was not at all accounted, right, what would be the carrying amount? That or recoverable amount, whichever is lower. Here also same thing. It's like that. Just for memory's sake, remembrance sake, I wrote this. So measurement principle, when this sale plan gets cancelled, the measurement principle is same as impairment loss reversal of CGU. Meaning, you need to find out 2 things, carrying amount and recoverable amount. What carrying amount? There you wrote, if impairment loss was not accounted at all from the first place. Here you will write, find out the carrying amount if this non-current assets was not classified as held for sale at all. Currently, On 1st January, you classified it as held for sale, no? And 2 months later or 3 months later, classification changed, plan changed. So what we are trying to find out here is, if this asset was not at all classified as held for sale, meaning if this Ind AS 105 ka provision, it was not at all applicable, means what would have been the carrying? If this Ind AS 105 provision, if it was not at all applicable on this asset, it is applicable, but if it was not applicable, what would have been the carrying? First find that. That is one limit. Second one is recoverable, whichever is lower. So on 31st March, you will show this asset as a PP at lower of these two amounts. You need to find carrying amount if Ind AS 105 was not at all applicable from the beginning, or recoverable amount, whichever is lower. Same like your reversal rules or a reversal of impairment rules of CG. That's all. We have one question, numerical question on this. Can we take this up? Take that up, people. Yes, you need to remember all these provisions, so they will not give it to you. Okay, so unless you know the provisions, you will not be able to solve these questions. Easy questions these are, provided you know the provisions. Okay, now look at the question now. Maybe I'll cover up this also. Presentation, you already know, sir. Once a non-current asset is held for, if it is, doubt is there, difference to SPL, I'll tell you in the question. Yes, Yagnesh is saying, sir, the difference between these two, you will book it as SPL. Yes, the difference will go off to SPL. Correct. That I will again show it to you in the numerical question. Correct. But yes, I agree with your point. Okay, next, last one is presentation. If it is non-current, separate. Now this is over. Now last concept here, presentation. You already know a non-current asset held for sale. If it is non-current assets held for sale, will you show it as PP in balance sheet? No, you will show it separately. Usually you show it under current assets. Now what if it is disposal group? Sir, if you have disposal group means it will have only one, it will have one asset or many assets? Many assets. Also liability. So once a non-current asset gets classified as held for sale, or if a disposal group gets classified as held for sale, then the disposal group ka asset and this non-current assets held for sale. This is individual, this is group, okay? Whether it is individual asset or a group of asset, doesn't matter. It should be shown separately in balance sheet. You cannot show it as under normal category. It should be shown separately in the balance sheet. That is one. Usually we show it under current assets. Okay. Now disposal group can also have liability. Even that liability should be shown separately in the balance sheet under liability side. Usually we show this under current liability. You can write liabilities held for sale or disposal group liability and show them. Okay. So this disposal group ka asset, show it separately in balance sheet. Disposal group ka liability, show separately in balance sheet. This is for group. If it's only individual asset you are planning to sell, means that individual asset will have to be shown separately in balance sheet. You cannot show it under other assets, a separate category. This disposal group ka asset, disposal group ka liability should not be netted off. Meaning this disposal group separately shown as asset in balance sheet, disposal group liability separately shown as balance sheet. Netting off these two and showing it as one number, not acceptable. Show separately asset and liability. These are the presentation aspect. Not that very important, but you never know, right? 1 or 2 marks may all this can also be picked up. Okay, sir. So I think more or less all the question we have done. Now just a question on this. I think this is a reversal. I think, yeah, reversal. Once again, we'll recap it for you. If it is non-current assets, if it is no more a non-current assets held for sale, if your plan to sell the asset is no more there, if you have dropped the sale plan, what you'll have to do? You'll have to remeasure this. One, you'll have to change the classification. From non-current assets held for sale, you will maybe classify it as PP or intangible asset depending on nature of the asset. That is the name change and category change. Okay. Second one, measurement change. Will any measurement change? Yeah. Once your sale plan changes, now this new asset, okay, on the day plan got changed, this asset will be measured at carrying amount if Ind AS 105 provision was not at all applicable from the beginning, or recoverable amount, whichever is lower. So you need to find this. Recoverable amount will be given to you. This one we need to find it and do the measurement. About this, we will learn in question number 3. It's an LDR. This question, I'll keep it as LDR. Let's do this question. Okay. S Limited, one company, they purchased a property for 6 lakh on 1st April 2021. So 6 lakh is your original cost. Useful life is 15 years. Fair enough. On 31st March 2023, 1 second. You purchased on 1st April 20x1. We are on 31st March 20x3. From here to here, how many years? 2 years has passed. 2 years you have used the asset, correct? So you'll have to depreciate the asset by 2 years. Okay, first, let's do that. How much is the residual value? Not given, 0. So original cost, the first year. This is the first year ended. Well, I mean, all this drama is coming on 31st March 20x3. That I've given date. Original cost was 6 lakh. 2 years you have used the asset. So calculate depreciation. Initially, when you buy the asset, carrying amount, original cost, same. So 6 lakh minus residual value not given. When you bought the asset, life was 15 years. Okay, so 2 years has passed, so multiply by 2. So depreciation is 80,000. So carrying amount on 31st March 20x3 is 520. This we have ascertained. Okay, next. Now let's read the data further. Impairment testing we did, provided recoverable amount as 470. Impairment testing. Sir, impairment testing is not as per Ind AS 105. Impairment testing is as per Ind AS 36. So on 31st March 20x3, impairment indicator came. When impairment indicator comes, we have to find recoverable amount. So recoverable amount was 470. So that means in this problem, first what? First Ind AS 36 ka impairment. Then Ind AS 105 ka accounting maybe. Let's see. Okay. So carrying amount is how much? 520 on the date of impairment indicator. What about recoverable amount? Recoverable amount is 470. We already know, people. As per Ind AS 36, we know if carrying amount is greater than recoverable amount, we need to book impairment loss as per Ind AS 36. Is there any impairment loss here? Yeah, these took a difference. How much? 50,000. This is the impairment loss as per Ind AS 36, which first we try to adjust with RR. If RR is not there, it will go off to SPL. Here, there is no RR data. So this 50,000 impairment loss, we'll book it to SPL. Correct, sir? Now, when you book impairment loss, carrying amount will get revised. It will reduce, right? From 520, carrying amount will reduce by 50 and it will become 470. From 520, it will reduce by 50 and it will become 4,70,000. Agreed? Okay. This is your Ind AS 36 ka drama. Okay, so let's come back to the question. The fair value less cost to sell is 31st March 20x3 was 4,60,000. Okay, now. Fine, they 1 minute, hang on. In fact, okay, 1 second, hang on. I think we didn't read one part too. Useful life of the asset is 15 years. And they said on 31st March 20x3, S Limited classified the property as held for sale. Oh, that means on the same day, 31st March 20x3, two things are happening. Okay. You did impairment testing also. And the property got classified as held for sale also. So on the same day, both are coming as first book impairment loss as per Ind AS 36. And then change the classification to Ind AS 105. That is the order. On the same day it occurs means first Ind AS 36 you apply and then Ind AS 105. Ind AS 36 ka accounting we have already done. Once you do Ind AS 36 ka accounting, the revised carrying amount has become 470. Agreed? Now on the same day, asset is also classified as held for sale. Once an asset get classified as held for sale, you need to apply Ind AS 105. And what does Ind AS 105 say? Such asset should be measured at carrying amount, that is this, after Ind AS 36 carrying amount is 470, or fair value less cost to sell, whichever is lower. On the same day, do you know fair value? Yeah, on 31st March 20x3 itself, fair value is 4,60,000. Fair value less cost to sell is 4,60,000 given. So you should measure this non-current assets held for sale at what value? The lower of these two value, which is what? 4,60,000. So this particular carrying amount of non-current assets held for sale as per Ind AS 105 will become 460. Got it? But currently its carrying amount is 470. From 470 you are valuing it to 460. So you are reducing. Correct? How much? From 470 you have to bring it to 460 means there is a reduction of 10,000. This 10,000 you will book it as impairment loss. But this impairment loss is as per Ind AS 36 or Ind AS 105? Ind AS 105. 10,000 reduction, you will book it as impairment loss, but as per Ind AS 105 and it goes off to SP. Agreed, sir? So the takeaway is, on the same day, impairment is also there. Non-current assets held for sale is also there. So if both same day, if they have given means, first to do Ind AS 36 ka accounting, afterwards do Ind AS 105 ka accounting. That's what we did. Okay, sir ji. Now, when you book impairment loss, again carrying amount will change from 470. Carrying amount will reduce by 10 and it will become 4,60,000. That's your revised carrying amount. If you want, you can write over here. Here only we wrote, no? Revised carrying amount of non-current assets held for sale is 4,60,000. Correct, sir? And that means in this year, 2 impairment loss you have booked. One as per Ind AS 3650, one as per Ind AS 105, 10. So totally 60. I've just given it for your reference there. This is first year ka drama. Any numbers, any doubt, anybody? Can I read next para? Next para is probably for next reporting period ka data. Anything you're updating, anything you're processing, you want me to wait, or we can go ahead and read the next para. Okay, so let's move forward to the next one and see what we can learn from that. Okay, same question ka, there is one more para. This is the drama on 31st March 20x3. Now on 31st March 20x4, next reporting period, management changed the plan as property no longer met the criteria as held for sale. So the plan to sell is still on or plan cancelled. Management has changed the plan, meaning they don't want to sell the asset anymore now. Okay, sir. The recoverable amount on this 31st March 20x4, the day plan got changed, sale plan got cancelled. On that day, recoverable amount is 5 lakh. So you need to find out the value of the property for the year ended 31st March 20x3 and x4. 31st March 20x3 ka value we already found 460. If you want, you can write it. The revised carrying amount on 31st March 20x3 is 4,60,000. This was one of the requirement of the problem. We have done. Now next year when the plan got changed, we need to find out the value. Okay. All right. Sir, one second. Jayant is asking something. Sir, on 31st March 2023, how did we get to know it is non-current assets held for sale? Given no much, in the question they gave. On 31st March 20x3, company classified the property as held for sale. They only told. On this day, it is classified as held for sale. They gave. On the same day, impairment also came. It also became held for sale. Mention. Comfortable? Okay. This is over. Okay. Last year ka closing balance will become next year ka opening balance. But, yes, correct. Agreed. Now, carrying amount or existing carrying amount of non-current assets held for sale for the year ended 31st March 20x4. 1 year later also, the carrying amount is 460. Do you agree with my statement? For the first year ended, carrying amount was 460. For second year ended also, the existing carrying amount is 460. Do you agree with my statement? This is year 1 ended ka value. I'm saying year 2 ended value also currently in our books is 460. Why? Why? Harish is saying yes. Why? Because once you classify a non-current assets as held for sale, depreciation will come or no depreciation? No depreciation. That means if first year ended value is 460 means second year ended value also is same. Correct? For second year ended, currently when the second year is ended in our books, the carrying amount of non-current assets held for sale on 31st March 20x4 is also 460 because we have not accounted depreciation. All this you don't have to write in exam. Okay, sir. This is our existing carrying amount. Okay. Now, 2 points. Can I still show this as non-current assets held for sale? Can I still show this asset as non-current assets held for sale? No, because plan has changed. If plan has changed means this is a property, no? That means from non-current assets held for sale, now I have to make this as PP. Now I'll have to make this as PP. Correct? Now that is one classification change will happen. Because no more we want to sell the asset. That is category change. What about value? PP ka value will be 460 only? No, there is a provision. What is that? Whenever the sale plan has got cancelled or changed, we'll have to change, one, we will have to change the category, and 2, value also will change. So if your plan has changed means henceforth on that day, this particular asset will get valued at lower of 2 limits. What are those 2 limits? One is recoverable amount. Second one is if this Ind AS 105 provision was not at all applicable from the beginning. In Ind AS 105 you applied Ind AS, for the first year you applied Ind AS 105, no? If this Ind AS 105 ka provision was not applicable from the beginning means what would be the carrying amount? That you need to find. If this Ind AS 10 provision, if it was not applicable means what would be the carrying amount on the day plan got changed? Plan got changed on 31st March 2004. So that you need to find out. That is one limit. Compare with that with the recoverable amount, and lower of the 2 will become the new measurement basis. Okay. So first let's find. Now I'm writing carrying amount of PP. Do you appreciate that? Because it is no more a non-current asset held for sale. It is a property now. So PP, plan changed. I'm trying to find out its value. When at the second year ended 31st March 20x4. First, what do we need to find? If Ind AS 105 was not applicable means what would have been the carrying amount? Okay, 1 minute. Now people don't say if Ind AS 105 is not applicable means carrying amount would be 470 or 460 or whatever. Carefully observe. Last year, no, two things happened. Impairment indicator came and you booked impairment loss as per Ind AS 36. And also an asset got classified as held for sale. We need to find if Ind AS 105 was not applicable means what would be the carrying amount. That's what we need to find. Okay. So if Ind AS 105 is not applicable means Ind AS 36 is also not applicable. These two are complementary provision. One comes means other comes. One does not come means other also will not come. These are like what? Genti provision, girlfriend, boyfriend provisions. These are or separate provision. You can have impairment indicator without non-current assets held for sale also. Yes, no? Possible. Both are individual provisions. Yes or no? So though this is not applicable means impairment would still come. Correct? No, impairment can still come. That means what? This will you cancel or this will be there? This will be there. Even if Ind AS 105 was not applicable, then carrying amount last year would have been how much? Last year carrying amount would have been 470. Because of Ind AS 105, carrying amount became 460. If Ind AS 105 was not applicable means this 10,000 impairment loss would have not come and the carrying amount would be 470. Do you agree? That's what I've started with. Check. So if Ind AS 105 was not applicable means last year ended balance would be 470. Last year ka closing balance will become year 2 ka opening balance. Year 2 is ending on 31st March 20x4. So year 2 will begin on 1st April 20x3. So opening balance would be 470. Correct? Sir, once a non-current asset is held for sale, depreciation you will not charge. Correct? Now what are we trying to find? If Ind AS 105 is not applicable means what would be the carrying amount? Correct? So if Ind AS 105 is not applicable means depreciation will come. Correct? That means you have to depreciate the asset for 1 more year. Last year you depreciated for 1 year. Correct? Now this year also you need to depreciate. Because we are trying to find if Ind AS 105 is not applicable, what would be the carrying amount? So depreciate the asset for 1 year. Okay, fine. Sir, can we take original depreciation? No, we can't. Because impairment came, no? 36, Ind AS 36 ka impairment came, right? When impairment came, carrying amount got revised. Once carrying amount got revised, you will have to recalculate the depreciation. This will not hold good. So recalculate. What is that? Revised carrying amount 470 minus the residual value 0 divided by life. Sir, when you bought the asset, 15 years was the life. 2 years is already over. 2 years is already over. So life remaining is what? 13 years. So divided by 30. This is your depreciation. So after depreciation, this would be the carrying amount. Now this would be the carrying amount if Ind AS 105 was not applicable at all. If Ind AS 105 was not applicable means this would be the carrying amount. Any doubt in this number, people? This is the only calculation which is important. Or if at all you lose marks, it's because you did some mistake here. Otherwise, everything is straightforward. Once more, got it. This calculation. Once more, got it. Everybody, just give me a quick response, people. If you have got it, let's move forward. Or I think you guys are copying. I think no, that's the reason. It's probably difficult for you to comment. Okay, saying got it. Fine. So this is the limit. So whenever plan gets changed, we'll have to remeasure the asset. For that remeasurement, we have 2 limits. What is the first limit? First, find carrying amount if impairment if this Ind AS 105 was not at all applicable. Find out the carrying amount if Ind AS 105 was not at all applicable, which is this, or recoverable amount, whichever is lower. Now plan changed on 31st March 20x4. No, on 31st March 20x4, what is the recoverable amount? It is given how much? 5 lakh. So it is lower of these two. Lower of these two. So which is the lower of these two? 433,846. Going forward on 31st March 20x4, it is no more non-current assets held for sale. Plan change, no? So that means category also you need to change. So it becomes PP. So the carrying lower of the two is this. Okay. So the revised carrying amount of PP will become 4,33,846. PP ka revised carrying amount on 31st March 20x4 will be 433,846. That is one. Okay. But currently it is 436. No, currently in our books, it is shown as non-current assets held for sale at what value? Currently, because before all this plan change drama, we are still showing in our books as non-current assets held for sale at what value? 460. Currently, we are showing it at 460. From 460, we need to make it to 433,846. From 460, you need to make it to 433,846 because last year it was 460, no? Correct? So, same thing will be carried over to this. So, currently in our books, we are showing it as non-current assets held for sale at 460. From 460, if you have to make it to 433,846 means it is increase or reduction? Reduction. How much is the difference of these two? 26,154. That difference you will book it as additional charge to SPA. You will book off that loss in SPA. That's all. And the revised carrying amount of PPE will become 4,33,846. That's all this is done. A good question according to me. Okay. For depending on the requirement, around 4 to mark. If this they've asked means, I think it should be like 4, at least 4 marks should be given for this. You never know, sometimes it can come for 2 marks also. ICAI gives this question as an in the case-based question for 2 also they can give. That we don't know, but ideally, yeah, it should carry 4 marks in my opinion. However, people, this is the value. The value they asked for first year and second year, we found out. Got it. Okay. Fine. I think next is discontinued. I said no, the standard has 2 parts. Non-current assets held for sale and discontinued operation. Non-current assets held for sale portion we have done. Discontinued operation is there. It's the same as AS24 we studied in CA intermediate. So let's do a thing. Maybe let's take about 10 minutes break. Come back and do the remaining concepts and questions. Thank you.